On May 6, 2010, the United States stock market lost almost $1 trillion in 20 minutes. Shares of some of America's biggest companies, corporations worth tens of billions, briefly traded for a single penny. Others spiked to $100,000. And then, almost as suddenly as it began, the market clawed its way back, as if nothing had happened at all. It would become known as the flash crash, the most violent 20 minutes in the history of the modern market, and for years nobody could explain it. Investigators chased algorithms, hedge funds, foreign governments. They wrote a 100-page report and still couldn't say for certain what had happened. It would take them 5 years to find the answer. And when they did, it didn't lead to Wall Street, or to Washington, or to some shadowy room full of bankers. It led to a small house in West London, under the Heathrow flight path, where a 36-year-old man still lived with his parents. This is the story of how one man, trading from his childhood bedroom, helped knock $1 trillion off the value of the world's largest economy. How he did it with a trick as old as markets themselves, and how in the end, the man who outsmarted Wall Street couldn't outsmart the people who came for his money. His name was Navinder Singh Sarao. To almost everyone who knew him, he was simply Nav. He grew up in Hounslow, a working-class corner of West London where the planes pass so low you can read the airline on the tail. His family was modest. His ambitions at first were not unusual, but Nav had something most people don't. A strange, almost uncanny ability to look at a screen full of numbers and see what everyone else was about to do. In his early 20s, he took a job at a trading arcade, a room full of young men betting their firm's money on the markets, keeping a cut of whatever they made. It was fast, brutal, and unforgiving. Most people washed out. Nav thrived. He wasn't trading stocks. He was trading futures, specifically contracts tied to the S&P 500, the index that tracks America's 500 largest companies. And he traded them the old-fashioned way, by reading the order book, the live scrolling list of every buy and sell order waiting to be filled. To most people, it was noise. To Nav, it was a language. He could feel the market tense before it moved. By his late 20s, he was one of the most successful traders in the building. He was also, by every account, deeply unusual. He wore the same worn clothes for days. He ate at McDonald's. He kept tens of millions of dollars in his trading account and treated the number not as wealth, but as a score in a video game. Proof that he was winning. He had no real interest in spending it. He once asked to take a day off because it was too sunny and he wanted to go outside. But the market Nav had mastered was changing underneath him. The human traders he'd learned to read were disappearing, replaced by machines. High-frequency trading firms running algorithms that could buy and sell thousands of times a second. The market was becoming a war of software against software, and Nav, watching from his screens, began to wonder if the machines were just reading the order book, the same order book he'd spent years learning to read. Could he fool them? To understand what Nav did, you have to understand how a price actually moves. Picture the market as a giant ledger with two sides. On one side, buyers, each stating the highest price they'll pay. On the other, sellers, each stating the lowest price they'll accept. The price sits in the middle, where the two sides meet. When buyers crowd in, it rises. When sellers pile up, it falls. Now, the machines that came to dominate the market in Nav's era didn't have intuition. They had rules. And one of the most important rules was simple. If you see a wall of sell orders building up, get out of the way. Sell first before the price drops. That was the weakness Nav found. He commissioned a piece of custom software, a modified, automated trading program built to his specifications. And with it, he began placing enormous sell orders into the market. Not one or two. Hundreds of millions of dollars worth, stacked in a towering wall above the current price. But here was the trick. He never intended to sell a single one. The orders were placed just high enough that they wouldn't actually execute. And as the price moved, his software moved the orders with it, always staying just out of reach, always keeping the wall intact. To the algorithms watching the order book, it looked like a tidal wave of selling was about to crash down. So they did what they were built to do. They sold. They pulled their offers. They got out of the way. And the price fell, exactly as Nav knew it would. Then, in the chaos he'd manufactured, Nav would quietly buy at the lower price. And the instant he'd made his money, his software would vanish the wall, canceling hundreds of millions in fake orders in the blink of an eye before a single one was ever filled. The technique had a name: spoofing, creating a lie in the order book, phantom supply, phantom demand, to push the market where you wanted it, then erasing the evidence. It was, in essence, a bluff. A bluff played at the speed of light, hundreds of times a day, against machines that couldn't tell they were being bluffed. And it worked spectacularly. If you're finding this fascinating, subscribe. The next story's already in the works. Over the years that followed, Nav's bluff made him a fortune. Prosecutors would later estimate he earned around $40 million. He didn't move to Monaco. He didn't buy a yacht. He kept trading from the same bedroom, in the same house, under the same flight path. The money stayed on the screen, a number that climbed while his life stayed exactly the same. He was not, however, invisible. The exchange where he traded, the Chicago Mercantile Exchange, noticed the strange, enormous orders that kept appearing and vanishing. More than once, they contacted him, asking him to explain. Nav was not contrite. According to court records, when the exchange warned him about his orders, he pushed back, insisting he could place his orders wherever he liked, and telling them, in effect, that he was simply showing the market his intentions. He even seemed to enjoy it. He had found a flaw in the most sophisticated financial machine ever built, and no one could quite tell him to stop. But Nav was playing a more dangerous game than he understood, because his spoofing wasn't happening in a vacuum. It was pouring fake selling pressure into a market growing more fragile, more automated, and more interconnected by the day. He was pulling on a thread woven through the entire global financial system. And on May 6, 2010, that thread finally snapped. The morning of May 6th was already tense. Across the Atlantic, Greece was sliding toward financial collapse, and fear was rippling through the markets. Traders were nervous, the machines were jumpy. And that morning, prosecutors would later allege, Nav was at his screens, running his program, layering the order book with one of the largest walls of fake sell orders he had ever built. Hundreds of millions of dollars in phantom selling, dropped into an already frightened market. Then, in the early afternoon, a separate event lit the fuse. A large investment firm in America launched an automated sell order of its own, a genuine one, worth billions, programmed to sell as fast as the market could absorb it, with no regard for price. The fragile market buckled, and then the machines turned on each other. The high-frequency firms, sensing danger, didn't just stop buying. They fled. The very algorithms that were supposed to provide liquidity, to be the buyers of last resort, simply switched off and disappeared. And with the buyers gone, there was nothing left to hold the market up. It fell off a cliff. In a matter of minutes, the Dow Jones plunged nearly 1,000 points, the largest intraday drop in its history at the time. Almost $1 trillion in value evaporated. On trading screens across the world, reality came apart. Shares of Accenture, a company worth tens of billions, briefly traded for 1 cent. Other stocks shot upward to $100,000 a share. For a few surreal minutes, the market simply stopped making sense. And then, just as fast, it came back. The algorithms returned, the buyers reappeared. Within 20 minutes, most of the losses had been erased, leaving behind a financial system in shock and a single, haunting question. What just happened? The official investigation took months. The first report, released that autumn, pointed to the large automated sell order as the trigger, and largely moved on. Nav's name appeared nowhere. He kept trading. But quietly, regulators kept digging through the data, the billions of orders placed and canceled in the milliseconds around the crash. And buried in that ocean of numbers, one pattern kept surfacing. A single account, placing and vanishing enormous walls of sell orders, again and again, in the minutes before everything fell apart. It took 5 years. But in April 2015, the trap finally closed. British police, acting on a request from the American Department of Justice, arrested Navinder Sarao at his parents' home in Hounslow. The man accused of helping trigger the flash crash was led out of the same modest house he had never left. And here, the story turns. Because what investigators found was not the villain they expected. Nav was charged with fraud and spoofing, facing the possibility of decades in prison. But when authorities went looking for his $40 million fortune, most of it was gone. The man who had outwitted Wall Street's machines had himself been an easy mark. Over the years, a parade of con men and bogus investment schemes had separated Nav from nearly everything he'd made, promising him huge returns, exotic tax advantages, the chance to multiply his score. He had handed his money to fraudsters, and they had simply taken it. The irony was almost too perfect. A man who had become a master of financial deception, undone by the oldest deception of all, and it left him in a bizarre position, a multimillionaire on paper who couldn't raise his own bail. He spent months in one of London's toughest prisons, not because he was dangerous, but because he genuinely could not get to his money. In the end, Navinder Sarao did something almost no one in his position does. He cooperated completely. He pleaded guilty. He explained his methods to the government in extraordinary detail, becoming a kind of teacher to the regulators who had hunted him, helping them understand how spoofing actually worked so they could catch others doing it. Doctors determined that Nav had autism, that the same wiring which let him see the market with such inhuman clarity also left him strangely indifferent to consequences and easy to exploit. When his sentencing finally came in January 2020, the judge faced a strange figure. A man who had moved $1 trillion, lost his own fortune to swindlers, and shown no real interest in money beyond the game of it. The prosecutors who had pursued him asked for leniency, and the judge agreed. Navinder Sarao, the man at the center of the flash crash, was sentenced to a single year of home confinement. He went back to Hounslow. But the deeper lesson of the flash crash was never really about one man. Nav didn't break the market with brute force or with billions of dollars. He broke it by understanding something the people who built it had missed, that they had handed the controls to machines that could be lied to in a system so fast and so fragile that a single, well-placed bluff from a bedroom in West London could send the whole thing into freefall. We never really fixed that. The machines still run the markets. They're faster now, and more powerful, and just as capable of vanishing the instant they're truly needed. Spoofing was made a federal crime, and Nav became the warning the regulators point to. But the fragility he exposed is still there, humming beneath the surface of every trade. Somewhere out there, the next thread is already being pulled. If you enjoyed this, please subscribe. Coming next, the 20-year-old who fooled Wall Street with a $300 million fake company.